Welcome, everyone, to our webinar on early stage investment instruments and startups, particularly concentrating on safes and convertible notes. I'm Kirsten Leut, and I'm going to be your moderator today. I head up university relations here at Osage University Partners. We'll go to the next slide. I'm so happy to be joined today by our two panelists, Adam Sterling and Manny Stockman. I'm going to have them each introduce themselves for a minute or so here, and then we'll move on to our next slides. But we'll start with you, Adam.
Sure, good to be here. I am Adam Sterling. I am an associate dean at Stanford Law School. In a past life, I was a successful social entrepreneur, a failed tech entrepreneur, turned venture capital and startup attorney, turned academic, and I've been teaching courses in venture finance for almost 15 years at Berkeley and Stanford. And together with the National Venture Capital Association, I founded 6 years ago VC University, which is an online platform that provides training and community for emerging and aspiring venture capitalists. So we might talk a bit about that later.
Yes. So glad to have you here, Adam. Manny.
Yeah, happy to be here. I'm Manny Stockman. I'm a managing partner at OUP. I focus on the physical sciences and tech world, where we're investing in anything from semi and photonics to materials and AI and cybersecurity. I am not failed in venture nor successful in venture. You never know which one you'll be for decades, but it is a great place to be. Before that, I was a failed R&D engineer at Lockheed Martin after grad school because I left before any of my early stage stuff could actually come into the real world. But I really appreciate this being put together, and thanks, Adam, for doing it with us.
Yeah, well, in my case, as they say, those who can't do teach. So here I am teaching.
Well, we're delighted that both of you are here today to talk about this particular subject area. But before we actually get into our subject area, we'll go to the next slide. We want to just mention a few logistics, as we always do on our webinars. The recording of this webinar and the deck will be sent to all registrants next week. A recording of this webinar will also be available on OUP's partner portal and via our YouTube channel. The partner portal that I mentioned is an online portal for tech transfer officers and researchers at our partner institutions, and it's full of relevant tech transfer and startup content. All registered members of the portal can find the downloadable presentation deck and video link for this webinar on the webinars page that we have in there, which is under our startup resources section. But instead, you could just use these handy dandy QR codes that are on this page to get linked to our partner portal or to our YouTube channel and find lots more content from our previous webinars there. You can also note that we have upcoming webinars. We have a webinar on June 3rd that will be exploring venture debt, a strategic option for startup growth. We have panelists from Bank of California and Western Alliance joining us to talk about venture debt and how that works for startups. And then on August 19th, we have a webinar that is going to be on advisory boards for academic innovation operations, featuring three different panelists about their advisory boards for their innovation operations at their academic institutions. So we're really excited about both of those webinars. So keep an eye out for registration for those coming up. We do encourage questions throughout their webinar. Please use the Q&A tool for your questions. We got a lot of questions beforehand, but for this webinar, please use the Q&A tool. It's the best way for me to keep track as I'm moderating these questions rather than putting them in the chat. So next slide, please. A short intro on Osage University Partners. For those of you who do not know us, we're a venture capital fund that partners with academic institutions to invest in their startups, typically by exercising participation rights in those startup companies through the licenses that the universities have with the startups. For those of you who don't know what participation rights are, they are the ability to invest in future rounds of a company on the same terms and conditions as other investors. And we do have recommended language if any of you are not yet including this in your license agreements at academic institutions. So as part of this partnership, we offer a host of benefits to our partners, including a share in our profits, as well as programmatic support on tech transfer and academic startups. We're now on our fourth fund here at OUP, and we've made investments in over 150 different startup companies in all areas of deep science. And we'll go to the next slide to just show you a smattering of those companies that we've invested in so far. We have both a life science investment team as well as tech investment team, and within those areas have invested in a lot of different sub areas. So if you ever have questions about our model, please do just reach out to us. We're always happy to answer them. So with that, we'll just go to our brief agenda for today. So just really quickly, Adam mentioned VC University before. It's an amazing training program for anyone who wants to learn the ins and outs and depths of venture capital. As mentioned, he was one of the founders of VC University. They are actually having their current cohort being put together now, I think for their 22nd cohort. Is that right, Adam?
Yeah.
Crazy. How many cohorts you've already had with this. We'll put in the chat in just a minute to everyone in case you'd like to learn more about VC University, how to do that. Then we're going to now have the slides that Adam has put together. These are slides are actually taken from a couple of his courses from VC University. So talking about our subject area. And then we will go on to a Q&A section. Again, I mentioned that a lot of you sent in questions beforehand, but please do, as you have questions as we go along here, just put them in the Q&A tool and I will ask them as appropriate as we go along here. So with that, Adam, I'm going to pass it over to you to put up your slides and we'll go into our subject area.
Okay, great. And Manny will jump in whenever he feels comfortable. I'll also turn to him throughout. Great. So what we'll do today is a bit of level setting. We're going to work through a sort of a simulated financing of a hypothetical company, which I'll introduce in just a moment. We'll start with some pretty simple examples. We'll provide an overview of the venture financing process, and then we'll actually build a couple of simple pro formas together. So a pro forma cap table is a cap table that models a event, and in this case, we're modeling a financing. What we're going to do is model a simple price round, like a Series A, where there are no convertible notes, our safes converting, and then we'll do it again where we are actually converting the safes or convertible notes in the round. And then we'll finish, we won't build it together, but I'll show you a more complicated pro forma that has sort of multiple tranches of safes, including post-money safes. We're going to start because I think it's helpful for you to understand. Years ago, Y Combinator, which I'll talk about, switched from using a pre-money safe to a post-money safe. And so I'll show you how that works. And we'll play with that more complicated approach. So we're sort of build into that, but I'm happy to share the slides as well as the Excel files that we'll be working on together. For our hypothetical, I want to pitch to you my new startup. I said I was a failed tech entrepreneur, but I still hold out hope. So today we'll be talking about my new startup. If you haven't seen from the video, you can see online, I am bald, or as I like to say, follically challenged. And so I thought over the years, what are some solutions to my baldness? And one idea is I could get a toupee or a wig. But the problem is, if I sort of showed up next week like this, you would all know that this isn't my real hair because no one grows hair that quick. Other solutions don't really work for me. Hair transplants, I don't want to fly to Turkey and go through a painful procedure. I'm too busy with work and kids. So my big idea, my invention, which will service the billions of humans who suffer from hair loss, is the first hairpiece that actually grows over time. So if you see me on campus next week, I'll look like this. A few weeks later, I might look like this. Maybe a couple months, I have coverage on my whole head. And then 6 months from now, I look like this. I'm really excited because finally came up with a name. It's not that, it's Airbnb. So today we're going to imagine that I am raising money for my new startup, Airbnb. So let's talk for a moment about the sort of stage financing model that is typical of venture-backed startups as they scale to reach different milestones and ultimately create momentum towards an exit. So the first stage of financing is actually when we incorporate the company. And during that, we actually are exchanging for our founders, in this case, me. I actually have a co-founder, but I'll introduce him a bit later. So the founders are going to contribute a combination of cash. And usually when you incorporate a company, you are writing a check for a few $100s. You're also contributing any IP that you might hold individually into the company. And in exchange, you're getting common stock, which is that's what makes you an owner in the business. So that is technically our first round of financing. We'll come back to this, but now most startups, after they've incorporated, before they do a price round of financing, before they do their Series Seed or Series A, where they're actually selling preferred stock, which is common stock with some extra benefits for the investor, some extra economic benefits, some extra control benefits. Most startups these days will raise money, so they'll find investors who will contribute cash to the company in exchange for a convertible security. And I'll talk in a moment about the different forms of convertible securities. Then they'll do their first price round, which we'll call a Series Seed or a Series A. And there's really no like legal rules around what you call your financing. Most startups, I think their first price round will be a Series Seed or a Series A. Back when I practiced law, we had a client that decided, hey, I want to call it a Series Awesome, which, I tend to encourage folks to innovate with your business models and not your legal or financing structures, but they were allowed to. Unfortunately, they never got to their Series Badass. Things didn't work out for them. So, again, save your creativity for your business and your products. So during that first price round, a couple of things will happen, and let me try to bring up my pointer here.
I can see it.
Okay. Oh, there it is. Okay. So a couple of things will happen. So you will have a venture capital firm. This is sort of the new money. They'll be contributing cash into the company, and in exchange, they're going to get preferred stock, the Series A preferred stock. But these earlier investors who bought the convertible securities, they're also going to be exchanging or converting those convertible securities into basically the same form of preferred stock that the new VCs are getting. Let me stop my annotation. And then this will sort of occur on and on where you may do a Series B and subsequent rounds of financing. And in those subsequent rounds of financing, you'll often have a new VC coming in, putting in more money, getting preferred stock. The existing VCs, they may put in more money to maintain their pro rata ownership if that's something they were able to negotiate for in the prior round. Manny, I'll pause there. Any sort of
Yeah, I was actually going to ask you a question that I think I have generally heard a few times and never know if I give the right answer. When your co-founder comes in with more wealth than you,
yeah,
and he's willing to use that wealth in between the first and second round to support the company, pay salaries for first employees. What's the
like right
right way?
here,
What's that?
like right here.
Yeah, what's the right way for a co-founder when only
Yeah.
one co-founder of two, let's say, has the resources to do that? What's the way for them to put that money into the company?
What we generally recommended is that it's really important to basically paper that contribution into the company. And so in most cases, it's we would say keep track of what you as a founder contribute or your co-founder contributes on like a simple promissory note.
Mhm.
And then when you do the next round, I think it's helpful to often consider like paying out that promissory note, so that there's some parity there. And there's different ways you can do it. You can, it gets tricky if you're sort of giving them more equity in the
Right.
company. Maybe they can do it through a convertible note that they convert into preferred stock later on, but then you want to be mindful of sort of the ownership percentages there. I think in most instances, it's helpful to, at some point in the company's fundraising life cycle to just pay that founder back.
Right. Yeah, I've heard a few times um, co-founders say, well, I'm putting more money in, so I should get more founders' equity. And that's not what we suggest. Like it's either you just deal with it like debt, true debt, and a payback, or maybe it's like a convertible note. But
Yeah.
generally, at the same point, like I think it should just be paid back
Yeah.
and not a
And yeah, I think the idea of founders equity, right, is to sort of incentive, create align incentives for the founders to build the company. And you're not really doing that by just contributing more cash at the onset and
right.
getting more equity through that. So and this, I think where people get tripped up is like you are usually writing a check for a few $100s. So the common stock, when we incorporate or start the business, we take the position that it's not really worth anything because all value in the company is sort of speculative. And so, but you for sort of legal and tax or accounting purposes, you do end up writing a check for the like value of that common stock, which again, it ends up being, you may get 5 million shares and write a check for $500. So that's more of a sort of a technical
Different.
thing.
Right. Yeah.
So just to give some sense of the background of convertible notes and safes. So I sort of put them under the umbrella category of convertible securities, right? So in the instance of sort of venture financing, debt, preferred stock, founder stock, these are all considered securities. And then securities laws apply. We won't get into that. I'm happy to do a future. I have a great 1 hour lecture or even 30 minutes on securities laws. But just for the moment, assume we're under the umbrella category of convertible securities. Now, historically, we maybe 15 to 20 years ago, what that usually meant, or where we usually saw convertible securities, were in sort of what I will call bridge financing. So the common scenario was a startup is doing their Series B. They've already, executed their term sheet. Everyone's ready to go, but things are taking longer with the lawyers. And for whatever reason, and this is quite common, like the company's not going to be able to make payroll before the deal's going to close and the wire is going to be made. And no one wants to, like, everyone's certain, like, nothing's wrong with this company. We just didn't plan things super well, which, again, financings always take longer than you expect. And so what will happen in those instances is either the new investor or the existing investors will say, hey, we'll give you $500,000. And what we'll do is we'll paper it on a simple convertible note that basically says, here's a $500,000 loan. When we finally do close the round, probably in a couple of weeks, that $500,000 will just convert into whatever that preferred stock is in that next round. And maybe what we'll do is, because we're taking on a little bit of risk and we're doing you a favor, we'll incorporate like a small discount. Like we'll actually convert at a price that's 5% less than what the preferred stock is being sold at, just to reward us for this. So that was the most common use of convertible notes in the venture financing context, and it was great because to actually facilitate a Series A or Series B financing, there's multiple legal agreements. It's a complicated process, a diligence. So you're looking at weeks, if not months, to get those done. Whereas we could probably paper and get the company this $500,000 in an afternoon if we're focused on it. So at some point, folks sort of realized and are asked, like, what if we sort of considered this to be a bridge financing, right? Like the company needs some money before they're ready to do their first price round of financing. So what if we sort of consider this like we considered that bridge round, where we're going to give them money and paper it on a convertible note or form of convertible note, and it will be faster, easier. And basically what we're doing is pre-purchasing Series A or Series C stock, but we can do it very quickly in a few days probably. And when we first started seeing this happen, 10 years ago, these were smaller dollar amounts, at most was, like $500,000. And then what really changed this was, I think mostly YC, but Y Combinator, the big incubator, and then to a lesser degree, another big accelerator incubator, 500 startups, they decided that all of their sort of accelerator or incubator investments, they were going to be done via convertible securities. And actually, they both created their own form of convertible security. Y Combinator, they called theirs the SAFE, our simple agreement for future equity. 500 startups called it the KISS, or keep it simple security. I actually helped make that security or draft that. At least to fast forward to today, YC at one point decided, hey, we're just going to sort of open source this legal agreement that we use to paper our investments. And they did that. And so now I would say that the vast majority of sort of investments in this stage are done via safes, the Y Combinator form of convertible security. And again, it's simply a form of convertible security. It does not, whereas most convertible notes have a interest and a maturity feature, the SAFE does not. I'll sort of pause there. I think we have some questions, but Manny, let me ask you, like, what are you seeing in the market? Is that true that most startups at this phase, are you seeing sort of different forms of convertible notes, or is everything on safes these days?
Many things are on safes.
Yeah.
It's now just become the dominant approach to it. And in an environment where you felt like there was much more risk on the round closing, the next round closing, the relative price round,
Mm-hmm.
um, you would be switching more towards convertible notes. So in general, safes, I treat them almost equivalently, even though legally they're not. But like, should we enter a time where it's, um, you know, really, struggling, the venture market's struggling, there's not much capital being deployed, you'd start to really probably switch back to convertible notes for that maturity date promise, even if just to have a little bit more protection on the venture side.
Yeah,
So,
I think that's a good point. It's a question of leverage, right? And when people ask me, like, as an investor, should I use a safe or a convertible note? And I said, listen, if I was investing and I had the leverage, I actually think the convertible note is a better vehicle for me because so the maturity feature, usually that's set, anywhere like around, let's say, 18 months from when on average, let's say. And in most instances, if the startup hasn't raised money from 18 months from the time you've done the convertible note, like you're gonna usually agree to extend that. But what it does is it creates a forcing mechanism for the startup to like check in with you, and they have to get your approval to extend the maturity date. And you can ask them like, well, where are you with your fundraising round, et cetera. It's hard to imagine calling it because at that point they probably have little to nothing that you could call the note with. Also, I think the interest feature, similarly, even though it's usually set at like a minimal number, it creates some time pressure, right? Like, the longer they leave that note outstanding, the more that will get converted. And again, as a investor in this stage, right? Like you are pre-purchasing that Series A or Series C stock. So what you're hoping for is that next round to happen. Like that's the milestone you're looking for.
right. And I'd say sometimes with safes, like we're still putting in the terms we care about anyway. Like you don't have to use the template. So we haven't put interest into a safe, but we put board seats into safes. So you kind of just make that clear that can be part of it. So you can paper anything is the reality of it. The safe template just gives you a good starting point to work off of.
Yeah, agreed. And I think the listen, I said, I think generally speaking, a convertible note is a better agreement than the safe. I think the safe's value is its ubiquity in the sense that like it's well known. It creates sort of there's a level of trust. I mean, I think Manny is a well-known, reputable investor. But if I'm a founder, like I'm going to be skeptical if someone's insisting on a safe with a lot of changes, right? Well, let's just go with the standard safe. But again, it's a question of leverage, and I think if you're doing this at scale, it makes sense to think about changes, side letters, et cetera, that work for you.
Yep.
Can I jump to some questions?
We do have a bunch of questions. And actually, so one of them actually was just about what you're talking about interest on an investment in these. And you already answered the first part about that sometimes there is interest. They're asking about the rate though, too. Does the rate vary a lot?
No, it's usually set at like LIBOR, like
Okay.
and it's a good if you're a founder and someone's like insisting on a higher interest rate or trying to negotiate the interest rate, it's usually a red flag that the incentives are off. Because again, like you're not investing via convertible note in an early stage startup to extract interest from them.
Okay,
So
great.
the standard is it's the lowest you can set it.
All right, great. We have a few more questions, and then I'd love to get back to your slides. Can you please elaborate on the difference between a promissory note and convertible note?
Yeah, a promissory note is just like a simple, like you're just papering a simple loan, and the idea there is that the person making the loan, at some point will be paid back, usually in cash. And then a convertible note is a more structured document where you're actually the investment is converting into preferred stock at a later date.
Great. Next question. Why do founders receive common stock and VCs receive preferred stock? It's a good question, but
Yeah.
it is something that I think that we need to cover here.
Yeah, I'm happy to
Yeah,
take it.
yeah, please.
And basically, this is just gets the power paradigm of investors. We want our money back first, is one think of preferred stock sits above common stock. And generally, in the way you structure the preferred
Yep.
stock, there's preferences on when you get your capital, when an exit happens. And so the number one thing I think about is that founders should think about is that, like, make sure you understand that preferred stock receives their money back first. Usually it's in this kind of 1x concept of, hey, we're going to get at least our money back if there's enough of it before before the common receives any of it. There's other terms that we can go into that would make that more valuable for investors, but those are generally in situations where the startup is struggling. But even a fantastically performing startup is accepting preferred stock from its investors. The other thing is there are separate terms, like we want, or separate more like voting rights for the preferred stock. So there are certain provisions in the docs you pen where preferred stock is voting as a different class. And so those come from things like accepting a new round of financing. Maybe you might have the preferred stock has to be in majority. It could be preferred stock voting as majority and the entire fully diluted voted as a majority. So it's about voting power and blocking rights that aren't just about everyone voting together. So the preferred stock creates like a different group of votes that represent the investor mindset. That's two things I think are important.
Yeah.
Adam, you want to add anything onto that?
No, nothing.
Okay. I'm going to ask two more questions. There are a lot more questions, but I'm going to ask two
Let's
more,
go. Yeah,
but like get us moving on. So one is corporate preferred and convertible stock has specific tax and liquidation priority implications. Is it the same or is it just similar terminology?
Ooh. I'm thinking, is this like a public company
I'm
question?
guessing so. Yeah.
Um,
I think it's, well, the liquidation priority. So Manny had mentioned in the case of preferred stock, you have liquidation preferences, which usually means if Manny is investing $10 million in purchasing Series A stock, like he is in the company is sold, like Manny is in most cases going to get either his $10 million back or he'll convert to common stock and take his percentage ownership, whatever is larger. Convertible notes have to do that sort of contractually. So they'll often have it like a change, like if you sell the company prior to the next round of financing, like in an acqui-hire, there'll usually be a provision that will say either we'll convert to common stock or we'll get 1.5x or 1x our investment back. So it's done contractually.
Okay.
yeah. I think
All
there
right.
are a few things in tax related stuff that venture firms like our finance team deals with that we're a little bit blind to. And like I think there are things in safes that are different than convertible debts because debt is different than safes and debt is a different financial instrument that our finance team has to deal with, but it's in the noise of the numbers we're typically thinking about on the investment team. So it's accounting definitively for some of these things,
Okay.
but not above the noise floor.
There is this sort of crazy thing that's happening. So, right, when you incorporate a company, you're issuing common stock subject to vesting to your founders, early employees. And then at a certain point, almost always after your first price round of financing, you start issuing options because you no longer are able to take the position that your common stock is worth a cent. But we historically, as an industry, has said that like these rounds, like the issuance of convertible debt, don't constitute like a material valuation event. So through this whole period, you're still issuing cheap common stock. Given the scale of sort of, and even the safe, and I guess the distinction there, it's a agreement for future equity, so it's still a loan. But I wonder how long that will last, that we can sort of take the position that the company is still valued at next to nothing. Anyway.
All right. I'm going to have us continue on. There's a lot more questions. We're going to get to them. Don't worry. But Adam, let's go ahead and go on.
Okay.
Because some of the next slides may answer some of them too.
Yeah. Okay. So let's just talk for a moment. And again, this is going to be pretty simple, and we'll get more complicated here. But let's just highlight how dilution works. So at this initial stage, we've incorporated Airbnb. At this point, the founders own 100% of the company. And then let's assume for a moment that we do a Series A financing, and let's look at a couple of options. So if I raise $2 million at a $3 million pre-money valuation, that means my company would be worth $5 million post money, and I've just sold 40% of the company, right? Because 2 million is 40% of 5 million. So after I've done this round, my equity has been reduced to 60% of the company. If I raise 2 million at a $8 million pre, the post money valuation would be 10 million. 2 plus 8 million. That means I've sold 20% of my company because 2 million is 20% of 10 million, and my founder's equity has been reduced only to 80%. So you can see here, same amount of investment, but what adjusting the valuation does to our dilution. But it's important to note that this does not include dilution from convertible notes. And in this instance, we're also going to be converting these notes, which are sort of just sitting on my cap table, waiting to take a bigger chunk of the dilution. And that dilution is going to impact all of the founders, the employees, the VCs who are coming into the round, as we'll learn. They're still going to get whatever they're negotiating for. So in this option A, they're still going to get 40%. In this option, they're still going to get 80%. And what's going to be reduced is the founder's equity here. So let's get a little bit more complicated. So what we're going to do is talk for a moment about just this. I keep saying priced round of financing. So this is like the Series Seed or Series A. We're actually negotiating a valuation for the company. You're going to negotiate the size of the option pool. We're not going to get into sort of the option pool too much today. I'll include a link for an article I wrote about how the option pool, sort of the conversation of the option pool, plays into sort of how we think about how a round is priced. We'll put that link in the chat. But in this instance, so a Series A financing, you're selling preferred stock, which again is common stock with some extra benefits, some extra economic benefits like the liquidation preference, often pro rata rights, which means if you buy 20% of the company, you have a contractual right to maintain your ownership in future rounds. You're going to negotiate a valuation for the company. Usually at this stage, the investors are looking to acquire around 20% of the company. You can expect significant governance change, new board members, many decisions of the company, including the decision to issue equity to future employees, investors. It's going to require the approval of these new VCs. And then the process is you're going to negotiate a term sheet, and then your lawyers, usually the lawyers representing the startup, are going to draft the financing documents. So let's just go back to Airbnb for a moment. Let's assume I incorporated Airbnb. There's 6 million shares of common stock. I own all 6 million. I find a VC willing to invest $2 million at that should say $8 million pre-money valuation. So our pre-money valuation is 8 million. We're getting $2 million of new money. Post-money valuation is 10 million. So post-financing, the VC expects to own 20% of the company. We discussed that. So to ensure that they own 20% of the company, let's quickly calculate the price per share. The way we calculate price per share is we take that pre-money valuation, and then we divide it by the pre-money calculation. And I guess I have another typo here. Let me just make sure I did this right. That should say 6 million, right? Or I guess let's go with, we're not going to use this for a moment. So yeah, it should have said 5 million before. So let's assume I issued myself 5 million shares, not 6 million. So we would take $8 million pre-money valuation divided by the 5 million shares that were outstanding. And that gets us $1.60 a share. That's what we're going to sell the new stock at. And the way to think about that is like, okay, I've got 5 fingers. All 5 fingers are the same. If I say, Manny, name me a price to purchase all 5 of my fingers.
Right. A dollar.
A dollar. So if Manny says all 5 of my fingers, he values those at $1. Manny, what's the price per finger then that you're paying?
20 cents.
20 cents. So similar here, right? We're saying we're valuing all your existing stock at $8 million. And so since you have 5 million shares prior to the investment, the way we get the price per share is by saying that 8 million divided by the 5 million. And then here's what the post money, the cap table would look like after the financing. So we have, right, Adam, I'm the founder. I had 5 million shares of common stock. For the VC, we are selling 1.25 million shares. And the way we do that is we just say we take the 2 million that they're investing and divide it by the price per share. And so 2 million divided by $1.60 is 1.25 million shares. And then we look at our total capitalization. So we had Adam's $5 million of 5 million shares of common stock. We've just sold 1.25 million shares. So now our total outstanding stock on a has converted basis. So if everyone converted to common stock, we'd have 6.25 million shares. And if we look at the percentages there, so I have 80% of the company, I've just sold 20% of the company, and we get 100% of the company. And the way the liquidation preferences would work, right? If Manny invested this 2 million and we sold the company for, let's say things didn't go very well, I only sold the company for 3 million. Manny could say, okay, either I get my 2 million back or I convert to common stock and I get 20% of the proceeds. Well, 2 million is more than 20% of 3 million. So Manny is just going to take his 2 million back, and then we share the remaining million amongst the common stockholders. In this case, it's just me. Okay. So let's talk about the focus of our conversation today, which is a convertible note financing. So again, one of the challenges in the venture world is like the terminology is all over the map. So people often call this like seed rounds of financing, but you also often see preferred stock called Series Seed. So you really have to dig a little bit deeper and see what's being sold. So again, like these will often be done on convertible notes. We talked about most likely it's going to be done via a safe. I mentioned the KISS. At this point, and this is an important distinction, we're not determining a value for the company. We're almost always negotiating a valuation cap. And all that is a valuation cap says, again, you're pre-purchasing preferred stock. We're negotiating what's the highest sort of valuation that you would convert that convertible security at. And we'll show you how that works. There's also a discount, which is simply like, if it's a 20% discount, that means you have the option to convert at 20% less than whatever the Series A is being sold at in the future. The biggest benefit here is it's much faster and cheaper, whereas the price round financing can take many weeks, if not months. This can usually be done in days. And oftentimes startups aren't even using legal counsel to get this done, although I think you probably should if it's available to you. And then you're not giving up any sort of control or shareholder rights. You are in the future, but at this moment in time, the safe investor is not considered a shareholder. And then we'll talk about the dangers of unforeseen dilution. So let's do a simple example of a convertible note, and then we'll do some more complicated examples. But I'll pause after this. So imagine that prior to the Series A we just modeled, I had sold $1 million of convertible notes with a valuation cap of 5 million and a discount percentage of 20. And so recall that I raised $2 million at an $8 million pre-money valuation, and I held all 5 million shares of the company. So basically now what we have to do is convert that $1 million convertible note. And there's two ways that we can convert it. And we're going to automatically convert it using whichever method gets the investor the most shares. So if we use that 20% discount, all we do is say, okay, our Series A price is $1.60 a share. The conversion price for that $1 million, one option is just take 20% off. So what's 80% of $1.60? That's $1.28. So that's one option. But if we use the valuation cap, we basically redo the price formula, but instead of using the $8 million pre-money valuation, we use the valuation cap. So it's going to be 5 million divided by 5 million, and that gets us a conversion price of $1 per share. Now, as the investor of the convertible notes, you prefer to have a lower conversion price because that means your $1 million converts into more shares of Series A stock. So that's what we're going to use here. And this is just sort of done automatically. So I will pause there. And should we do some, or let's look real quickly at the cap table. So here's what it looks like now. So this is the same scenario, but in this instance, we have done, let me get my, hold on, my pointer here. Okay, I lost it. But anyway, you can see this. So Now Adam has five. So same thing. The only difference here is now the seed investor has 1 million shares of Series A stock, right? And that's that they invested $1 million. They were converting not at $1.60, but at $1 per share. So whereas the VC had to pay 2 million for 1.25 million shares, the seed investor, the convertible note investor, only had to pay 1 million for 1 million shares. And then now, if we look at the fully diluted cap, if everyone converts to common, whereas even though I thought I was only selling, $2 million at a $8 million valuation, I thought I was only selling 20% of my company. I'm now selling 69%. But if you look, there's a problem here. And I guess people can't jump in here, but Manny, what have I failed to do here?
Think about options.
Well, that too, but Manny, if you're the
Oh,
VC here, right? Like, what's your expectation of ownership if you invested 2 million at an $8 million pre-money valuation?
oh, we own 20% of the company.
Yeah, and in this instance, you're only owning 17% of the company,
Right.
and that's because we have it currently written. Manny is also being diluted by the conversion of the seed investor, but Manny's going to say, no, 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 I need 20%. That dilution has to come fully out of you, Adam, not me. And so this is totally standard, and we'll show you in a moment how we do it to make sure that Manny maintains his 20%. So we can pause for questions.
Just a quick one here about the valuation cap. How is that usually determined?
The market decides
Yeah.
is really the right way to think
Okay.
about it. So generally, like that's just a negotiation, just like a price round. And sometimes you're in a situation where the founder has control and they kind of say, this is the deal, take it or leave it. But generally, that happens more in like the angel-ish type rounds where there's not an institutional venture fund or a seed fund negotiating at the table. And so as more and more institutional investors are doing convertible notes and safes for large checks, it's just like a normal negotiation. What happens as you think about multiple investors in a convertible note or a safe, they're taking there's like one, there should be, if you're all generally happening at the same time, there should be one price. And this goes into an MFN clause, most favored nation clause, or also best practices around note purchase agreements. So everyone sees that they're on the same agreement are things that we highly encourage.
Yeah, agreed. The valuation cap is really about upside protection. And so, as I mentioned, like historically, these convertible securities just had the discount feature. And then, but what was happening, so let's say, here you invest in a startup via convertible security, you just have like a 20% discount, no valuation cap. Now, and then the company has some like crazy event and they do really well, like, and the Series A is at a really high price, like, even though you're getting a 20% discount, like, it's still, you're converting at a very high price. And you might think, well, when I invested here, like, there was no, the company was nothing. And so I don't feel like I'm really participating in the upside. And so the introduction of the valuation cap was sort of upside protection in favor of the investor. And so generally speaking, the investor wants that to be low, the startup wants it to be high. If I'm advising a startup and they're trying to have a negotiation about this, I would say, like, given the history here, like, the valuation cap should be what you think a reasonable expectation for the Series A valuation might be. And that way, if we do much better, you're getting a benefit of the upside. But Manny's right, that's not how it plays out in practice. It's just sort of market driven.
Great. I would keep moving on. We've got a lot of other questions, but I think there are ones that we can answer after we get through this.
Okay. All right. So now we're going to get a bit more complicated and we're going to actually build a pro forma together. So now forget what I said about Airbnb before. Here's what our cap table actually looks like pre-financing. So there's two founders, myself and Jeff Bezos, a fellow follically challenged traveler. So we issued, when we created the company, 8 million shares. Each of us split it 50-50. So we each hold 4 million shares of common stock. And then we actually created a stock plan. So we set aside, when we started the company, 2 million shares for our stock plan. At this point, we've issued a million of those 2 million shares. So imagine we have a few employees, consultants, and collectively we've issued them 1 million shares out of our employee stock plan, and we still have a million shares available. And this is right before we raise a round of financing. So if you think about it, Adam owns 40% of the company, Jeff owns 40% of the company, our employees collectively own 10% of the company, and we still have 10% of the company available in our stock plan. So now imagine we've gotten a term sheet. Let's look here. We're just going to, for a moment, assume that there is no convertible, that we went right, because of Jeff Bezos, we were able to go right to our Series A. And so imagine there's a VC fund called Big Money Ventures, and they are going to invest $5 million at a $20 million pre-money valuation. And we negotiated a 15% post-money available option pool. I'm not going to spend much time on the option pool, except to say, basically what this means is after all is said and done with the financing, 15% of the company has to be available to for future employees, contractors, etc. And the investor needs to be protected from that. So that if we have to increase the option pool to achieve that, we need to make sure that the VC is not being diluted by that. So you'll see what that looks like in practice. That actually does impact price. And oftentimes, I think some VCs may use that as a way to sort of reduce the price. Like you as a founder may be dead set because your buddy and your incubator, they got $20 million pre-money valuation and you're insisting on a $20 million pre-money valuation, but the VC thinks the price is too high. Well, you'll see if you push up the option pool, increase it to 20%, that will actually lower the price per share, but it can create other problems, and we can talk about those. So let's actually model this out. So what I'm going to do is I'm going to stop sharing it here. Okay, I'm going to move this over here. I'm going to open up my spreadsheet, and I will share these. Okay. Hold on. Okay. Let me share my screen. Sorry. Okay. Let's go full screen. Let's zoom in a little. Okay. Hopefully folks can see that. Okay, so this is a typical pro forma. This is actually, I have this from 15 years ago when I practiced law. I think they look pretty similar. I imagine a lot of people use like cap table platforms like Carta. So you probably won't spend much time on this as a founder or an investor, but I think it's good to know how they work. And when you do an investment, this will option. Usually the company's counsel will create the pro forma and then they'll include it with the term sheet. Oftentimes they'll try to just give you a PDF of this, but someone on your team should be like asking for the Excel and sort of reverse engineering it. Manny, how do you sort of handle these process-wise? Like what's curious?
We have generally we have pro formas we use and have built over the years, and then also sometimes the lawyers create them internally. We have our own way of doing them, and usually it's something a little bit more reduced in terms of our name, and then having just the other class of investors. But your legal team really puts it together. I've seen to have it be detailed by investor, and then also there's all these new tools like Carta, which do it for you automatically. But we're looking at something generally exactly like this, Adam, when we do ours.
Great. Okay. So up here on the left, we have like our major terms. So let's start entering some of this. So pre-money, we said this was just negotiated. This was $20 million. So I'm going to put 20 million there. The new money, that's what's being invested, and that's 5 million. So Big Money Ventures is investing 5 million. The post money, it's simply 20 plus 5, right? Because if a company's worth 20 million and all you're doing is adding $5 million of cash, that's what increases the value accordingly. So price per share. So what that's going to be, we talked about that. It's going to be the pre-money divided by, we're going to go down here and you can see this is what I showed you before. The blue side is our pre-money cap table. The green side is our post-money cap table. But what we do is we divide it by the total stock pre-money. Remember the fingers, right? All the fingers are worth 20 million. And to get the price per finger, we divide 20 million by the number of fingers. So we'll do that here. So this is going to change. Right now it's $2 per share. And then we enter in, we negotiated a post-money option pool of 15%. Now, if you can look up in the formula, I want to do a couple of things here. And I'm going to do, it's not necessary for this exercise, but I'm going to share these Excel documents with you. And I at least want you to see why I'm doing things the certain way, because these formulas can get pretty complicated, but they're not. Like, all the formula here is B4 divided by C24. But I want to do a couple of things. The first one is we need to round this to the fourth decimal point. Because if you sort of, and I'll sort of come back to that. Right now, it's a nice round number. But for those that are familiar with Excel, like Excel, it will only show me 4 decimal points, but I can extend this. And this, if this is not a nice round number, it may be like $1.876543678, and it will only show me the 4 decimals, and it will just, for the purposes of convenience, round to that 4th decimal. But what happens is when you actually like paper the agreement and do the stock purchase agreement, the lawyers will just write in the 4 decimal points. So we actually have to force Excel to round, not just to show us what rounding would look like, because that's going to flow through the rest of the model here. So this, what we're doing here by saying, don't just show us what it looks like to round to 4 decimal points. We actually want you to round to 4 decimal points. I'll explain, that will come up a bit later, but just why that, you'll see that here. The other thing, and this is just, there are a few ways to protect against this, but for those that have spent a lot of time in Excel, you know that like if you have a complicated spreadsheet, that in algebra, right, we can't, if you can't do, you can't have a division formula where the denominator is 0. And in Excel, if that happens, it creates this error that's really hard to fix. And even if you do like undo, it's, you sort of often have to start over your entire Excel. So the way I've always done it, and I know there are better ways, is I make this a conditional formula. So basically, I won't do it here, but in mine, I've got this conditional formula that says, hey, Excel, if the denominator is ever 0, I want you to just give me the words NA. And if it's not 0, you can just run the formula. And that's how I protect against this problem. You can probably, I think I already have it built in here. See, like this says, hey, Excel, if the denominator is 0, then say NA. If it's not, run this formula. But right now, because it's 0, you see it says NA. Okay. So now our starting point is that we're going to sell the Series A stock to Big Money VC at $2 million per share. So we're going to come over here to the new money. So Jeff and Adam, we're not putting in any new money. Our stock plan, we have 3 actual rows here. We have, remember, our stock grants outstanding. We've got 1 million shares that we've already issued. We've got 1 million still available on our stock plan. And then this row 19, we're going to have to increase it to get to 15%, and we'll play with that here. And then this row here shows Big Money VC. So we know they're actually putting in $5 million. So we're going to do that here. Now we're going to calculate how much. We're going to come back to this column, column F, actual amount due to share rounding. But right now we're going to calculate how many shares of Series A stock Big Money VC is getting. And we go, we've done this already, 5 million divided by price per share. Okay. Now we have to do another rounding here because in venture, we don't issue fractional shares. That's just standard practice. So what we're going to do here is, in this instance, we don't have to worry about it for now because it's a nice round number, but it's not going to be that for long. So what we're going to do is round up, and this is standard, to the nearest whole share. So I'm just saying to Excel, make sure you round up to the nearest whole share. Now, post-money common stock, we can just bring this over. Jeff Adams still has 4 million shares. Jeff still has 4 million shares. Our employees should still have 1 million shares. We should still have 1 million shares outstanding. And now we can look at this. So we can pause here for a minute. And what this is telling me is that if we are issuing 2.5 million shares of Series A stock to Big Money VC, and we look here at our total stock. So we had 10 million before. We're adding 2.5 million. That gets us to 12.5 million shares of total stock. That makes sense. Big Money VC has 100% of the Series A stock, and then the fully diluted stock, Big Money VC has 20%. So, Manny, why aren't we done here?
Because you got to figure out the actual amount that they should invest.
Well, we have to do that too. But one other thing, what's the problem here with the total percentages? What have we failed to do that we've negotiated?
Oh, the notes. Or
We're
I
gonna
don't
do
know.
that later. So right now, right? Remember,
Oh,
so
the increase
yeah,
in
the
the option.
stock plan increase, right? So right now, so everyone's been diluted by the 20% dilution has been sort of distributed across everyone. So Adam and Jeff, we've each been diluted by 8%. Our employees have been diluted by 10%. And then that million shares that we had available, which represented 10% of our company before, that now only represents 8%. But recall, we had agreed we'd have 15% available. And we need to protect Big Money VC from that. So we still have to increase the option pool here. So what we're going to do is we're going to come over here because we're going to increase it with option stock. And to figure out how much we're going to increase it by, we're going to go 12 million, so the total stock, and we're going to multiply that by 15%, but we're going to subtract the 8% that we already have available. And then watch what happens. So right now, that formula tells us that, okay, Airbnb, you should increase your option pool in connection with this financing by just over 1 million shares. That's going to create more dilution because every time we issue more shares, people are diluted. But look what happens now when we add these two together. So if we take the 1 million shares that we had before the round, plus these 1 million plus that we're adding it by, these two add to 15%. But then Manny, has the Big Money VC general partner,
No, we're not happy. Well,
yeah,
no. I mean, unless it was in the terms of the agreement.
right.
But yes, right.
But in most instances, we have to get you to 20%.
Right.
But right now you're being diluted by this option pool increase. So what we have to do to protect Manny from that dilution is we come over here to the pre-money and we're going to increase the total fully diluted by the option pool. And then that's going to flow through because remember the formula for price per share is pre-money divided by this total fully diluted cap. So we're going to come over here and we're going to move this. I'm sorry, we're going to come over here and do it. This is going to be up. So we're going to go over here and we're going to go this equals, and watch what happens. So a couple of things are going to happen. So now Manny's got his 20%, so he's happy. Everyone's diluted even further. This number changed a little bit, right? Because if you keep in mind that like it's a there's sort of a feedback loop happening here, and as the price per share changes, then the size of this million becomes less, so we actually have to increase it a bit more. But it all works out when you sort of see it in its final form here. So now Manny's at 20%. Now I want to circle back to something and then I'll pause for a minute. So I didn't deal with this column actual amount due to share rounding. So remember I said in venture, we don't issue fractional shares. And now we're actually, the roundup here is doing some work. And so it's important that, so Manny has Big Money VC. He's actually getting a bit more for his $5 million, but it's for an accounting and auditing purposes, it's important that Manny actually pays for that extra fraction of a share that he's getting. So what we're going to do here is take the price per share and multiply it by the number of shares and then watch what happens. So that tells us that Manny, because he got a little bit of an extra, he needs to be wiring us $5,071,000. I always, in VC University, I sort of call this the Van Halen moment. So in almost all instances, you're dealing with this fractional, this rounding up. And so if you're ever on a financing and you're investing in a Series A and like the term sheet says you're investing 5 million, and then when you get your wire instructions and it still says 5 million, like something probably went wrong, and it's a good clue that you probably should have someone double check everything in the pro forma. I call this the Van Halen moment because Van Halen was this, well-known rock band from the 70s, 80s, and 90s. And one of the things they became known for was for their concerts. In their contracts with the venues, they'd have a provision that they in their dressing room, they needed a bowl of M&Ms with all the brown M&Ms removed. And everyone sort of thought this was just an example of them being like divas. But the reason they did it was sort of ingenious. They had a manager or someone that like was worried that they had these really complicated stage pyrotechnics, and the instructions for the safety of the pyrotechnics was in the agreement with the venue, and they were always worried the venue wasn't going to look at it closely, and like going from venue to venue, like they didn't have time to do a full check. So they snuck in this provision about the M&Ms, and it was a way for them that if they got to the dressing room and didn't see the brown M&Ms removed, they knew they had to probably double check all the safety provisions. So, you don't know if you personally are going to reverse engineer every pro forma, but this is a good red flag for you if you're not asked to wire some weird amount.
That's great.
Okay, let's pause for a minute. So this is pretty simple. All we did was model a Series A. Next, we're going to do this again with the assumption that we actually have some convertible notes converting, and it's going to get more complicated. But let's pause for a question.
I think I would go ahead and go through that so we can get to it.
Okay, I'm just going to get a water though.
Okay. Oh, then I will pause for a question.
One of the questions was good. So what the question was, when the convertible notes convert, do the investors get similar voting rights as the VC that's sort of in the price round? Yes. So the convertible notes, assuming they're penned this way, convert into the exact shares that are occurring in the price round. And there's always unique terms that certain preferred investors get depending on how much they invest. So if they are above a certain share count, they'll get major investor rights like the preferred investors do, but not all preferred investors in the price round always get those. So you do generally flow in to the same set of rights that the next preferred round comes in as.
Yep. Okay, let's move on. Okay, so back to our PowerPoint for just one more slide. Oh, that's not the right one.
I'll say one thing that Adam was doing there, I should comment on. When he was moving the option count earlier, the term we use for that is the options are in the pre. And so there's a term that investors use around the option pool that needs to be created, whether they're in the post or the pre. And so that's something that happens in convertible notes as well. You might have an investor in the next round that says all the notes are in the pre. I don't know which one Adam's going to show next, but it's math. It's just math, and it affects ultimately the dilution for the founders versus the investors.
Yep. Okay, let's change the scenario a bit. So let's assume for a moment that 1 year prior to doing the round with Big Money VC and Manny, we took $1 million from the Berkeley Angel Group. That they had invested $1 million on a safe that had a 20% discount and a $10 million valuation cap. Now, these are pre-money safes. The safes that are available today are post-money safes. I'll show you what those look like at the end. But again, I think it's for teaching purposes, it's helpful to start this way. So now we have to basically do that same pro forma, but we have to convert this $1 million investment. So let's go back now to my spreadsheet. Okay, so this is where we left things off, right? Where we had sold the 5 million shares to Manny and Big Money VC for 20% of the company. Adam and Jeff had been diluted down to under 30% each of the total outstanding stock. Our employees have been diluted from 10% to 7.2%, and we have 15% of the company now available. But we have to deal with this Berkeley Angel Group investment now. So they invested $1 million. So we'll put $1 million there. We'll put our terms here. It was a 20% discount, a $10 million valuation cap. Okay, so now recall that simple example I gave before where we have two options for what price to convert Berkeley Angel Group's $1 million investment at. And we're going to go with whatever the lower of the two prices are, because that's what is how it's written in the contract for the safe. So the discount, to get the discount price, again, it's pretty simple. It's going to be 1 minus the discount times the price per share. Okay, so that gets us to a $1.45 approximately. The cap price, a little bit more complicated. We're going to take the valuation cap now as the numerator, and we're going to divide it by the total fully diluted. Okay, that gets us to 90%. And we're going to round here to 0. Okay, and that makes sense, right? It's well, wait, what do we 10 million divided by that? Oh no, round to 4. I did the wrong. There we go. Okay, so half. It's half the price per share because right, our numerator cuts in half. That makes sense. We're automatically going to go with the lower of the two, which is the 90 cents. And then to calculate the conversion shares, we're going to take the investment amount, divide it by the conversion price, and this one will round to 0, to the nearest whole share. Okay, so this is telling us now that Berkeley Angel Group, for their $1 million, should be getting just over 1 million shares. So we're going to want to bring that up to our cap table here. So they're going to be getting Series A stock. So we're going to move this up. The number changes a little bit because remember, anytime we're issuing new stock, right? Like that's going to increase the total stock post money. And then anytime we increase the number here, the total stock post money, that means we're going to have to issue more shares to get our option pool to 15%, which in turn is going to lower the price per share. If you're doing this, if you're opening up this Excel spreadsheet on your own computer, this is what we call an iterative calculation, and you may see an error. You just have to go into your settings and click Enable Iterative Calculation to deal with that error that you might see, okay? So now a couple of things are happening here. So now things looking a little bit different because we have to deal with this 1 million plus shares of Series A stock that Berkeley Angel Group is getting. And look at the dilution. So now Adam and Jeff, who started the day thinking they owned, before the financing, 40% each of the company, now own just over 26% of the company. And Berkeley Angel Group, for their $1 million, are getting just over 7% of the company. Manny, what issue are you going to still have here?
Investors aren't at the 20% they thought they were. You already mentioned the option pool.
Yep. But now you're being diluted by the
right
Angel Group.
Right. Because so they were right now, the way it's done is in the post, it's called. The notes are converted in the post. Yep.
And Manny, I think there's some, this is interesting because it's not dealt with in the agreements. It's more sort of negotiated. I think there is a market approach here. But if you look at this now, how are you thinking about your dilution from the Berkeley Angel Group? Are you insisting that you get to the 20%? Are you okay with this?
For us, it comes down to the projected multiple we think we want to get in the round. And so this comes to how we negotiated the valuation. And so if for some reason, I think this has to be, a $1 billion exit, a 20.25x, I'll make sure my valuation I gave you in this function matches that return. So I might have negotiated a different valuation if I told you the convertible note was okay to convert in the post. And so it felt like you were talking about earlier, founders may say, hey, I want that $20 million valuation. And so if they do, but I still want 20%, I'll say, okay, well, then the notes will convert in the pre.
Yep.
And so it just comes down to that. If you're okay with a slightly lower valuation, then I'll say, fine, put them in the post. So that's kind of how I generally think about it.
So in the way, if Manny insists on the converting notes being in the pre-money to maintain his 20% here, the way we would do it, it's a bit different than how we dealt with the option pool increase. So what we're going to do actually is go to our price per share formula up here and insert it there as opposed to bringing it over here, because we don't actually want to, if we do it here, we add to if we move these shares here over here, it's going to create this weird effect where the Berkeley Angel Group is getting a protection from their own dilution. So what we're going to do here is change the denominator from just C25 to C25 plus that it's going to be I23, which is the shares that the Berkeley Angel Group is getting. And then watch what happens if I did this right. I always mess up the number. Let's see. There we go. There's the 20%.
Right.
So this is pretty typical, right? So we've got a startup that raised $1 million on a safe, one safe, and then raised $5 million in a Series A. And you can sort of see what happened to the ownership percentages post money. So they've effectively now have sold over 27% of the company from that $6 million of investment. And where things can start to get weird, and when I share this with you, you can play with it. What I want to do now, and then we'll take the last 10 minutes plus for questions, is show you, we won't build it because we don't have time, but I'll show you a more complicated version of this. So let me share another one of these. Okay. So this is another hypothetical company. Let me go full screen here. Okay. So, and this was actually based off of this. This is like a case study I did based off of an actual company's financing. So we're calling this fake company LexMind AI. And they did a $20 million Series A at a $100 million pre-money valuation with a 15% post-money pool. We had, let's say, two founders here who prior to the Series A, similarly each had 4 million shares. Similarly, they had 1 million shares issued from their stock plan. They had 1 million available. They had to increase their option pool to get to 15% post-money. But they had a much more complicated experience before the Series A. So they had gone through YC. And the way I think YC is structured today for their accelerator is they end up issuing you two safes, one at 125,000 and one at 350,000. That 125,000, that converts at the equivalent of 7% of the company. So basically what they're doing here is they're taking that 125,000 and we ignore the 125,000 to get the number of shares they get from that one safe. We're simply taking the total stock after the Series A financing, multiplying it by 7%. And so from that $125,000, they're getting 1.7 million shares. YC also did a $350,000 safe post money. And for that safe, I think they just do Manny mentioned this before, an MFN. They basically say, we'll get whatever the best deal is you get for future safes you issue. So they also then, after they were in YC, they raised $5 million from two different groups. First, they raised $2 million from Stanford Angel Group with a 20% discount, a $10 million valuation cap. And that's what YC ends up getting. And then, this is here, hold on. And then they did $3 million from Berkeley Angel Group with a $20 million valuation cap. So this is also this is more of probably a sort of the outer bounds of what we're seeing, but it's not crazy to see a AI startup that raised 20 million and $100 million pre-money valuation for their Series A, went through YC and raised 5 million on safes. That's actually probably within the bounds of sort of what we see in the market. But then sort of look what happens here when you have sort of more money on safes, a really high Series A, right in this instance, the investor who's investing $20 million, they're getting 16% of the company, but collectively the investors that invested on convertible notes for a total of what is it here, just over 5 million, they're getting 32% of the company for $5 million. And then look what happens to the dilution of the founders. Michael and Diana went from 40% down to 16%. And now you're getting into the zone where, and I'm curious, Manny, how you might look at this. And we might even see more extreme examples than this, where you're worried now about are Michael and Diana like, do they have a sufficient amount of equity to be incentivized to build this business?
Right. Yeah, we think about that every time we're looking at some of these rounds where they have um, generally like it's the notes that really took away the ownership from the company, from the founders. And there's only, one way to fix that ultimately, and it's to plus them up with options after the company raises the round. And so you have to eat out of that option pool increase if you think that the founders need to be more incentivized. Um, and generally, if we're not setting the terms of the round, we don't necessarily, the other way is to increase. But if you are setting the terms of the round, you give them a higher valuation, but then you're buying less of the company. And so it is a dynamic to really think about. And it's happening in these AI companies all the time because they launch so quickly. They're able to get these YC notes and other angel group notes that get most of the ownership. And so it's a challenge.
Yeah, and this is where like safes can be dangerous, right? If you're doing too many at different terms, and one outcome may even be that Manny may say to the startup here, like, for this to work, you have to go back to you know your convertible note or your safe investors and get them to agree to take a haircut, no pun
Right.
intended. And then they have to decide like, do we even though we can refuse to take a haircut, we may believe that in order to get, for Manny to actually lead this round, we're going to have to. YC's not going to do it, and they're probably not going to be asked to do it, but because of the leverage they have in the market. But it's something that it creates a level of complexity that at the time of basically issuing these, it can be easy not to think about that.
Right. Absolutely. And that's where like one of the strengths of a convertible note originally was when you were taking money from angel investors, you know, their goal, their interest in a note is to get access to the company and to invest in the company with some upside. So with real upside, to be a part of the big financial institution round that they probably wouldn't have access to as angels. And the challenge, of course, is they need to be rewarded for some of that. They need the upside that Adam was talking about earlier, but who's going to define that? Like if Stanford Angel Group got this note in at a $10 million cap, and then 2 months later, a well-known VC prices it at 100. I mean, it sounds like the angel group kind of just took advantage of the company in some ways. So you have to make sure you're accepting terms also from a group that understands the market they're in, the potential valuation of the company, and these things are really important when you're taking money from angel investors, is that they know what's fair also. And if they don't, make sure you're doing the work to understand it, or be careful with the caps you're putting on the company.
All right, let's ask some questions. And I'm going to try to have you guys to give short answers if possible, because we've got a bunch of questions and I know we have to leave all in 10 minutes.
Yeah,
All
and
right.
I'll
Um,
share those slides. Look, you might want to
Absolutely.
look at the Stanford. If you look at that row with the Stanford Angel Group versus the Berkeley Angel Group, the Berkeley Angel Group is a post-money safe. The Stanford Group is a pre-money safe. So you can play with the difference and how those are calculated to see the difference. But today, the dominant form is a post-money safe.
Right.
Okay, great. Well, that first question is about the the pre or post. So the question is, does the early investor get to negotiate whether their convertible note will be calculated as pre or post, or is it entirely up to the startup and then price round investors? I think it's really a negotiation. You guys have talked about this, but just quickly, your answers, Adam.
I think it's just now. I mean, if you go to the YC website to download this open form safe, it's post money, and so I think just by nature of that, we just in most instances it's not even discussed. It's just post money safe, and there is an elegance to that. It creates a bit more certainty to sort of think about what the conversion is going to look like. So I think it makes sense. Yeah, so I don't right, Manny. I imagine you're yeah.
Yeah, exactly right. It's penned in the document you agree to, and make sure it's clear whether you're doing a pre-money or post-money safe, whether if you're a founder accepting pre-money or post-money safes or notes.
Okay, great. Next question. Do the safe terms change if the value of the company changes? I imagine the value of the company is going to change from the time of the safe to the next price round. But answer the question?
The terms of the note do not change based on the price of the next round. The terms are the terms, and so the
Right.
share price isn't
It's
capped.
asking about the value of the company. If the value of the company changes, to
I
the
mean, I think it's
term.
private companies have no value until they're
Correct.
valued by someone,
There we
and
go.
so that's what the price round is.
Good
Okay.
answer.
Great. How should a founder evaluate if they should plan to go directly to a price round versus the convertible note round? How are they making those decisions between those? Annie, you want to go for that one?
It's a good question. So one of the challenges for university spinouts is like, what is their value when they have nothing other than a team and some technology and ideas? And so the decision to go after a convertible note safe round versus a price round should sort of be around like, are the people that are interested in giving you money sophisticated enough to price it? And if they're not, you would probably lean towards more towards a convertible note or a safe note, which kicks the can down the road to someone a group that can price it. Um, that's one comment. The other is if you have leverage, right? If you're a fast moving AI startup and the preferential terms that you can get in a note, like an uncapped note with a low discount, that's generally where even institutional investors like us, like others, will say, okay, we just got to get in this company. Let's do fat. Let's give them what they want. Um, Not many strings, no real boardroom governance. Like it's kind of like the who has the leverage. Um, Sometimes the way I might think about it.
Adam, LLCs and safes. Do LLCs often use safes?
They shouldn't. Yeah, it's interesting, right? If you have so you do see occasionally an entity formed as an LLC, and then in almost all instances, when you do your Series A, you're gonna have to convert into a C corporation. And so, and in most instances, you should probably do that prior to doing your. I haven't seen it often. I guess you could, but I think
I
I
mean,
would.
I see university spinouts sometimes form an LLC. It's like, why? Just don't. I mean, or just before you take money from anyone, just convert to a C corp.
Yeah.
Don't complicate things.
All right. Are safes using the YC template usually advantageous to founders and why? And it's the context of this question is understanding that convertible notes usually give investors more leverage than safes.
Yeah, I think they're generally speaking advantageous to founders. And then you sort of, and there's interesting, this phenomenon I didn't really pick up on until I started practicing. Like, if we were to sort of map the venture ecosystem and we looked at like who gets the best terms, it's usually the founders at the top VC fund. So like Sequoia is doing the most founder friendly deals, and sort of counterintuitive because you would assume Sequoia has the most leverage. But then if you sort of think about the companies that they're competing for are the founders who have the most leverage themselves. And so the same is true when you sort of think about YC. So YC wants a very founder favorable contract, the safe. But then the other thing is they are just sort of almost completely optimizing for the upside, right? And a lot of the things they don't care if their I talked about the maturity date is good because it forces the startup to check in with you. Like they're investing at a scale, it's like they don't care about that. All they're optimizing for is upside. What you can see by their terms do that.
Yeah, I agree.
Right. Manny, does the founder share the initial safe terms to the investor or the other way around? And what are the pros and cons?
Yeah, generally, I think like if you've already started to raise safes, like a few, like let's say it's like a 2 month window where you're raising and you're doing it in the form of safes, we want to come in at the terms that everyone else is coming at. And so then you share, like, hey, I just raised a safe from Adam's angel fund. Here's the terms. Do you want to participate? Uh, if I'm coming to you and I really want to invest, but you didn't want more money and Adam just invested, I have to come to you and say, hey, here's slightly better terms. So those are two nuances. But in general, like if it's a ab initio kind of new investment, bridge round, safe round, um, it's a negotiation where I generally think, an investor who's negotiating this will say, what are you thinking on valuation, just to get a sense of whether we're in the right ballpark. and then we will come to you with terms, just like a price round.
Great. We have 3 minutes left. I'm going to cram a couple more questions in. Adam, thanks for putting those links also into the chat. We'll actually share all these links too when we send out the decks to everyone. We also have a survey for everyone. If you could answer the survey, see, to let us know how this webinar was for you. Give us suggestions on future webinars that you'd like to hear about that have to do with university startups. We always appreciate that. Adam, next question to you. Actually, I think this is to either of you. I've heard that there's a downside to convertible notes because of where they sit on your financial books versus safe, debt versus credit. With respect to future rounds and even SBIR grants, is there a truth to that?
Ooh. Um, from a new investor perspective, if I'm thinking of investing in a company in a price round, I don't particularly pay too much attention to whether it's a safe or a convertible note, but I will pay attention to the terms.
Yep.
From an SBIR and like tax financial perspective, I don't know the answer to that. Adam, do you?
No.
Yep. Okay,
Um,
great. We'll try to find someone else to answer that eventually, but
yeah.
that's a good question. Um, how common is the MFN clause?
Less common than it should be.
Okay.
And I will say, but YC puts it in the safes that they do. And then if you go to the website to download a safe, there's a version that's you can download with the MFN. You can also put it into a side letter. So there's different ways to do it.
Right.
Okay. Um, what is the ability to sell safes back to the startup? How common is this practice? Do you ever see this happen?
I have not seen it happen.
Okay.
And generally, what when it so what it mostly because what Adam suggests, like if you're trying to get your money back, you invest in a company via safe so you can make a lot of money. And so generally you're not trying to get your money back. And usually if you're in a situation where the company's not doing well, they don't have the money to pay you back. I can imagine a situation almost like what Adam put up in that last Excel sheet, big round, high valuation, where the new investor might negotiate buying out the safe. That happens. I mean, investors are buying out previous equity in companies to get the ownership they want.
Okay. Great. Any last thoughts from either of you? We have run out of time, but I just want to make sure that there's no last thoughts that you want to impart to our audience. We will be sending out all the materials, the fantastic materials that you had today.
I'll mention like I still have scars from one company 7 years ago that ended up putting together like 10 safe notes on top of each other before their price round. And and maybe in this new world of AI, it's like you can just have Claude run the Excel sheet calculation for you, but it is mind numbing to do that when you have 10 different safes on different terms. And founders, like Adam said, don't know what they're accepting, what the impact is on their dilution, because they don't know what the next round of valuation is going to be. So I strongly encourage new founders who think they have the leverage to just keep raising safes and safes and safes, not to do that, because it does end up creating ill will with the investors that ultimately thought they were buying a certain portion of your company via the safe.
Thanks, Manny. Adam, anything from you?
No.
No.
Thanks for having me.
So appreciative of both of you being here today, imparting all this wisdom. We fit a ton into this 90 minutes. I'm sure there are going to be follow-up questions. As you can see from the slide that is up right now, we did provide the contact information for both Manny and Adam. If you want to follow up with them, this will also be in the slide deck that we sent everyone. Thank you so much for both for being here and for imparting all your wisdom on this topic today. We really appreciate it. And everyone have a good rest of your day. Thanks for being here.